Hello everyone, welcome to the channel. My name is Fula Kamara. There is a new feature that Intuit has added in 2023, which is the fixed asset, advanced accounting, and then click fixed asset. Then it will take you to this window. With this fixed asset module, you will be able to calculate depreciation and also keep track of your asset, your fixed asset, so that when filing your taxes, it's easy. You can just run the report and provide it to your tax preparer, which is easy because it keeps track of when the asset was acquired and then the salvage value, purchase price. You also have the asset name and the depreciation start date, because sometimes you might buy an asset, you can only start depreciation after you put it in service. So that's the reason why sometimes the purchase date and the service date, that is the depreciation start date, might be different because you cannot depreciate an idle asset. The purpose of depreciation is to charge to expense a portion of an asset that relate to revenue generated by that asset, because you just want to match the cost of the asset to the revenue that the asset generates, so that both the revenue and expense appear in the income statement in the same reporting period, which gives the best view of how well a company has performed in a given accounting period. Whenever we're depreciating an asset, we need to consider three factors. One, the useful lives, that is, how long do we think we'll be able to use this asset? Then we also have to consider the salvage value. That is, how much do we expect to sell this asset? This first one is saying after we've used these assets, we're expected to sell it at 5,000, which is an estimate. It could be maybe the actual salvage value might be smaller than this or maybe higher. So, but this is what we're saying right now. Then another factor also that we need to consider is the depreciation method. Depreciation expense can be calculated using an accelerated depreciation method or evenly over the useful life of the asset. So what are accelerated depreciation method? These are the sum of the year digits method. Then we also have the double decline. Then we also have, like, for the straight line depreciation, which spread the cost of the asset evenly over the useful life. So when you say cost minus salvage value, it gives us the depreciable amount. And then that depreciable amount is what we divide by the useful lives. Sometimes we can also convert, that is, if we are using a monthly depreciation, because every month we want to recognize the depreciation for that month. The QuickBooks Fixed Assets module makes it easier for you to calculate the monthly depreciation, because as soon as you plug in all the necessary information, you will be able to calculate the depreciation. The difference between the double declining method and the straight line method is, for the double declining method, the initial depreciation, you apply it on the cost. Let's say this is the cost. The first depreciation expense will be applied on this cost, not on the depreciable. Whereas for the straight line method, you have to deduct the salvage value from the 50,000. That is, the 50,000 minus the 5,000 gives you the depreciable amount. Then you say now the depreciable amount divided by the useful life, that gives you the depreciation expense. And the double entry to record that is, you debit depreciation expense and credit accumulated depreciation. And at the end of the day, accumulated depreciation affects the assets account, whereas depreciation expense goes to the profit and loss account as an expense, so which reduce profit. You cannot depreciate the asset below its salvage value. When we are calculating the depreciation, we don't take into consideration the salvage value when we are using the double decline method. Whereas for the sum of the year digits, which we are not going to cover in this tutorial because Intuit did not include the sum of the year digits, but that is also another depreciation method. The most popular one is the straight line method. So, but whereas for tax purpose, you have the maker's depreciation, also the double decline method. So if we want to know what will be the percentage that we will apply on the cost, so let's say in this case, they say the double decline method, right? So the number of years is 5. So we say 100, which is always the benchmark. We say 100 divided by the number of years, 5 in this case. So times, we double this amount. This is the time we use the double. So 20 times 2 will give you the percentage that we are going to use. So once you get this percentage, the difference between the straight line method and the double decline method, we don't deduct the salvage value from the cost before we apply the depreciation for the first year. So for the first year, we just apply it on the cost rate. So now the subsequent years, we are going to take out or deduct the previous year's accumulated depreciation from the cost, and then there's the carrying amount, which is the carrying value. So it is there we apply this 40% to get the depreciation for the next month or the next year. Okay, so that's how to calculate. But let's go, if they say 150 accelerated method, so 100 divided by 5, which is also 20, times 150 divided by 100 is 1.5. So we say times 1.5. This is the factor. So 30. So this 30% is what we're going to apply on the 50,000 to get our depreciation. Okay, depreciation expense for that year. So now we can, if we want, we can allocate that depreciation expense on a monthly basis. That is, we can divide it by the number of months to get the monthly depreciation. So we are going to enter depreciation using like the 3 methods, which is the most popular ones. We're not going to use the sum of the year digits in this case. So let's just say add an asset. So once you click add an asset, you can see you have the schedule, which is right now we cannot view the schedule until we have set up. So first we need to add the asset name. So in this case, we have to add the asset name. So in order for us to add, let's say this is fitting, right? In terms of the description here, you can add the serial number of the asset. Let's say if you know the assets, like if it is a vehicle, you can add the VIN number, then the purchase price. In this case, let's just say we buy it for 40,000. So this is the purchase price, and the purchase date, we'll just say today's date. And the depreciation method, you can see we have 3. We have the straight line method, the double decline, and the 150 accelerated. So we are going to select the straight line method in this case. So once we calculate the depreciation, I'm going to show you also how to do it manually, because when you know something how to do it, you can compare your results to the software result just to make sure if it is accurate. So now let's see the number of years in this case. Let's just say this is fitting. Let's just say 10 years. This is an estimated useful life, so don't take it for granted. Some assets has a lot different useful lives. So the salvage value in this case, the reason, even if though, so the reason why we're adding the salvage value, if we have a salvage value, so that's another factors. Like you have to estimate. Just imagine in 10 years, you say after 10 years, I'm gonna sell this asset for X amount. So remember that that's an estimate, and it's subject to what? Errors, right? The estimate might not be accurate. So in that case, so let's just say after 10 years, we're going to sell this for $500. So meaning, so now that we've got this, that's the reason why for the straight line method, you have to deduct the salvage value before you can apply the depreciation, because they don't want you to depreciate the assets below the useful life. Okay, because if we don't deduct this salvage value from this 40,000, then straight line, meaning we are spreading this cost of the asset evenly over the year. So if we don't deduct it from the 40,000, we just say 40 divided by 10, the remaining cost will be 0, because after the 10 years, the asset cost will remain as 0. So that's the reason. To avoid that is we are going to deduct the 500 from this purchase price first. So once we deduct it, now we know the remaining, which is the depreciable amount. That's the amount we are going to spread over 10 years. So now the asset account. What is an asset account? The asset account is the asset cost account. Let's say if you buy a computer, where do you record that computer, the cost of that computer? So it normally goes to the property, plant, and equipment. That is if you create a property, plant, and equipment account. So if you have not customized your account yet, you can go to the chart of account and customize it. If you haven't seen our tutorial on customization of chart of account, you can check out our tutorial on QuickBooks Online. So in this case, I already have a property, plant, and equipment. The reason why I just have a property, plant, and equipment so that I can lump all the assets that are depreciable assets to this specific account. At the end of the day, I will know the total assets, fixed assets that I have. So then the accumulated depreciation will also have an accumulated depreciation account that we've created, which is also part of the fixed asset. At the end of the day, the cost minus accumulated depreciation will give you the carrying amount. So that net amount is what will show in the balance sheet. So that's the reason why we have to, when we are recording depreciation expense, you see we don't credit the asset directly, because at the end of the day we are going to reduce the assets, but we are not doing the credits direct to the assets. We are going to credit the accumulated depreciation because we are going to disclose the accumulated depreciation amount and debit the expense. Whereas for the depreciation expense, this is an amount that we charge to the income statement. So we need to have an income statement account that name depreciation expense. So you see I have already created, you see the category is an expense because this is going to the profit and loss. So what we're saying, we are rationally allocating the cost of the asset to match the revenue, right? If we are saying this asset will last for 10 years, but at the end of the day, we're going to generate income from its use. While we're using the asset, we're generating income from it. So that's the reason why we're also going to match. We would have said, okay, let's just expense this asset. But because we are going to use this asset for 10 years and we want to spread that cost over the 10 years, that's the reason why at every year we're going to recognize a depreciation expense from that asset to match the economic benefits that it generates, which is the form of revenue. So now once we're done, we click save. So you can see this is the depreciation. So right now what you're saying is saying in 2024, we are going to recognize 3,950 as depreciation expense. Then 2025, you can see 3,950. So it's spread evenly over the useful lives. You see, you can view more 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So you see these are the number of years. So you see the last, on the 2033, you see the remaining value is actually the what? The salvage amount. So even though they've depreciated the asset from the original cost of 40, so now it has a remaining amount of 500 at the 2033. So which is the 4,449.64 minus the 3,949.64. So that gives you this 500. Well, let's just, if you want to like prove it, to say, you can recalculate this depreciation, right? We already know the useful life was the useful life was actually 10 years, right? So we have the asset is 40, so the cost, so and then the salvage value is 500. So we can just say the cost, which is 40,000, minus the salvage, which is 500, gives you what? 39,500. So that's the depreciable amount. So the 39,500 is our depreciable amount. So now if we want to know the monthly depreciation, so since we know the useful life is 10, how many months per year? So 10 years is the useful life. So how many months per year? 12. So times 12 gives us 120 months. So now 39,500 divided by 120, this gives us the monthly depreciation, which is 329.16. So if we, this amount that we're seeing right now is the annual depreciation. You see, you have just 2024. But if you click on the down arrow, you can see, you see this is the monthly. So for January, you have 329. Then you have February, March is the same amount, right? So now if we go back to our calculator, if we annualize this amount, say times 12, because that was a monthly, you see we have 3950. You see this is 3950. This 3950 is the total, whereas these are the monthly depreciation. So you see, that's how QuickBooks has made it easier for you. At the end of the day, the first depreciation, you are going to recognize it. So whereas the subsequent depreciation, QuickBooks will automatically post the depreciation. So you see, assets added successfully, the first automated depreciation entry will be posted on January. You see, so the convention that QuickBooks Online has used here is it's saying that if an asset is placed in service this month, in the month of December, the first depreciation will be in the following month. That's the convention. We also have some convention which are like the mid-month convention. So the mid-month convention might tell you that, okay, if an asset is placed in service maybe on the first of the month, the depreciation will be on the middle of the month. That is maybe the 15th of that month. So that is the initial depreciation will be if the asset is placed in service December 1st, meaning the depreciation for December will be prorated times half. Okay, that is times 50%. Then you also have like the full year convention. Okay, so that's how you have to pay attention to that, because some company, their policy is to apply depreciation on asset as a mid-month convention. That is, if they buy the assets in the month of, let's say, July, it doesn't matter the date, so they will just apply half of the depreciation. Let's say the 329 times 0.5 will give you the depreciation for that month of purchase. Then if the asset was also sold, then it will also apply the mid-month convention. That is, if it's sold, meaning they are going to apply 0.5 the month of disposal. Some company also might have a policy, a capitalization policy. In audits, we normally review the company's capitalization policy to see the policy on when they are capitalizing assets and when they are depreciating assets, because sometimes they may miscategorize the assets. Some assets might be depreciable, but they may miscategorize them into repairs and maintenance. That's why, as part of the audit procedure for fixed assets, we normally review the repairs and maintenance to see if an asset that would have been depreciated has been categorized into the repairs and maintenance. So now the next one is the double decline method. Let's say the asset here is vehicle. So this is the vehicle. Then we can add the serial number or the VIN number, or we can include the purpose of the asset. Let's say this asset, we bought it for 100,000. So in this case, depreciation method is double decline, and we can still enter the number of years. So let's say this is a vehicle, we can just say 7 years. Remember, this is just an estimate. I'm not checking against any policy. These are numbers that I just come up with, so don't take them for granted using them as a benchmark. Okay, so the salvage value, we can add the salvage value if we know the salvage value. Let's say 10,000. The reason why we are adding the salvage value, because we don't want to depreciate the asset below the salvage value. Okay, so that's the reason why we're adding it. But when it comes to calculating the depreciation itself, we don't take into consideration the salvage value for double decline method. So the assets account is also property, plant, and equipment. The accumulated depreciation is also the accumulated depreciation account. Then the depreciation expense, we just put in the depreciation expense, we click save. The cost of the asset is 100,000. So you can see the first depreciation, it's actually started in January, right? Because it's assuming that the first depreciation will be on the following month, even though we put the asset in service in December, so the first depreciation will happen in the following month. But if you want to like record a depreciation for this month, you can still use like a journal entry to post it. So now let's see, the total depreciation is 28,571. Okay, so now let's just use the trusty calculator here to recalculate that. So remember, we use the 5 years, right? Okay, the 7 years, we use the 7 years useful lives. So now let's calculate our first depreciation. Remember, we also have a salvage value of 10,000, so which we don't use in our calculation. Let's just prove it. So first, let's calculate. This is a double decline method. So first, we say 100 divided by 7, which is the useful lives. So which gives us 14.28 times 2 because we're using a double decline method. So our depreciation rate will be 28.57. Let's just keep it as that way. So if we say now the cost 100,000 times 0.2857. So you see, it gives us because the rounding, that's why you've seen we have 28,571.40 because we rounded the numbers. So this is our first depreciation. So now if we say 100 now minus 100,000 gives us the amount. You see, now we have, this is the remaining amount, which is the carrying value. So if we go into the next, our next depreciation now will be on the 71431. So we are going to calculate our next depreciation on this amount, which is 0.2857, if I got it right. So you see, our depreciation now is 2407, which is a rounding also. So you see, this is how you calculate the depreciation using the double decline method. But remember, this double decline method, it's the first depreciation is on the cost without taking into consideration the salvage value, and the subsequent depreciation will be on the carrying value. That is the cost minus the accumulated depreciation from the previous years. Then you apply the depreciation on the remaining amount, so which gives you the depreciation for the year. So if we drill into this, we can see these are the monthly depreciation. So the annual depreciation, which is the total 28,571, you spread it over the number of months. So if we say 28,571.40 divided by 12 gives you the monthly. So you see, now we have 23,800 for each of the months. So the annual depreciation is the 28 grand, and then the monthly depreciation now is this amount. So that's how to calculate the depreciation using the double decline. So if we go back quickly and enter the accelerated method, let's say this is a computer. So we can say the purchase price is 5 grand, and the date we put it in service. Let's just select the purchase date in this case. Remember, we can update. The reason why I just default to this date, because I just wanted to make it easy. You can put the back date, you can back this up to, let's say we say the purchase date is November 7, then we can say the day we start depreciation is the same date. We say, okay, we are going to start depreciating the asset in November, right? So the method is 150 accelerated method. Then the number of years computer, let's just say 5 years in this case. Salvage, we can say no salvage value, because after after use we can just dispose it. So the cost is property, plant, and equipment. That is the assets account. And then the accumulated depreciation will go to accumulated depreciation. And the depreciation expense will go to depreciation expense. Okay, so first we need to calculate, right? So once we calculate, so the accumulated depreciation amount is 120. So now you see it shows us this is the depreciation amount. So our first depreciation amount is 125 for 1 month, because we put the asset in service in November. So the first depreciation started in December. You see that? So they apply 120. So the next depreciation now will be next year, which is 2024 depreciation. The total is 1,425, but the monthly will be this amount. You see? So you see the amount is different. If we go now, you can see if we go to the gear icon here, you have the option to show what fields or columns you want to display here. You also have like the option to filter. You can filter here some information. Then you also have the option to add like multiple assets. You can also import the schedule, the asset schedule from CSV. We can look at the report. This is the asset report. So the filter here is saying that the last 12 months. So for the last 12 months, this is the assets that relate to 2023. Just export it to CSV, so you can send it to your accountant. You can also filter here to show which by asset name or by column, whatever option you want to choose. So you can do that as well. You have the more options here where you can schedule report. So you see, you can send these reports every maybe you can select every Sunday or whatever month, so you can schedule it. Now we can see this is the report. If you export this, it will show you the date the asset was purchased and the date it was placed in service, which makes it easier for you. So when you are sending this to the tax accountant or your tax preparer, it's easy for them to recalculate your depreciation when preparing your tax return. Thank you for watching. Please don't forget to subscribe, like if you like the video, comment if you have any questions. See you in the next video. Thank you.